lending is the process of lending cryptocurrencies to borrowers with a predetermined interest rate. It allows lenders to earn a consistent profit on unused cryptos and the borrowers to use these funds for other potentially profitable financial activities as well. Although the fundamental actions of borrowing and lending are the same as in traditional finance, crypto lending have revolutionized the practice in many ways. Today, we're joined by Josh Rager to talk about crypto lending. Before the discussion, please click on the like button, subscribe to our channel, turn on the alerts, and share this video with your friends. And if you have any questions about crypto lending, or if you have ever tried to lend crypto, let us know in the comment sections. Let's start. Hi, Josh. Can you tell us something about crypto lending?
Sure. So we'll first want to talk about banks, traditional banks, right? So banks are an important part of all modern societies. And of course, banks take the role of a third party who conducts lenders with borrowers in a secure manner. With that said, before approving any loans, a bank actually has to carefully review the borrower's financial and credit history to minimize those risks of a person or a company not paying back the bank. So in the worst case scenario, if a party is unable to repay a bank is going to be aware of any collateral that can be seized or sold to recover the loss. So because of this, banks are generally seen as safe, right? They're secure. They're safe options as far as when it comes to deposit and earn standard interest rates in local fiat currencies. So of course, in exchange for providing such services, though, banks will actually charge multiple types of fees.
Yeah, that's right. So what's the difference between crypto lending and bank lending?
So the most obvious difference between traditional banks and crypto lending is the currency used, right? Crypto lending is conducted with cryptocurrencies such as Bitcoin. And so one of the major implications of using Bitcoin is the price volatility. It's not uncommon for Bitcoin to experience large price swings, of even thousands of dollars within a day, within an hour, or even a few minutes. We've all seen it. So this means that regardless of interest rates, both borrowers and lenders can instantly experience significant gains, but also significant losses at the same time. Cryptocurrencies are a relatively new asset, right? So they have much lower liquidity than fiat currencies. And this somewhat restricts participation in crypto lending and makes loans much more limited in size. But crypto lending, it's got other benefits, when it comes to traditional banking that traditional banks can't offer. For example, the process of a background check along with filling out application forms can be a very tedious process whenever you're going to a bank in order to get a loan. And so with crypto, anybody who possesses, some Bitcoin, some Ethereum, or any token can actually participate in lending or borrowing almost instantly. While banks are still heavily reliant on paperwork, crypto lending is actually, it's entirely digital. And so in fact, crypto lending uses different mechanisms to actually ensure repayment, getting rid of the need for credit scores and background checks completely.
So how can we lend our cryptos? Can you do it on any platform?
Yeah, you can actually lend your crypto on both centralized and decentralized platforms. And so both of these platforms, centralized and decentralized, actually offer a way to earn interest on people's crypto. And however, depending on which platform you use, the process and risk can actually be quite different.
What is a centralized crypto lending platform?
So centralized crypto lending platforms are actually financial companies that specialize in cryptocurrencies. So they're very similar to traditional banks. Like banks, these platforms will take care of coordinating the movement of funds between lenders and borrowers, right? So the company will determine appropriate interest rates for each party and automatically process out the payments, which makes it easier. It's also up to these platforms to enforce and follow, procedures that ensure repayment. Now, because of these burdens, users have to comply with the terms of service with these companies, right? Including know your customer or KYC procedures. The company in turn will profit through the collection of different fees. Now, however, these companies specialize in cryptocurrency. The process of depositing and borrowing cryptos, it's quite simple and it can all be conducted online. Now, likewise, registration processes are largely effortless compared to traditional banks. And as long as users can trust in the platform's ability to keep assets safe and make the payments without delay, these in turn will continue to remain much more accessible and lucrative alternatives to fiat banks. Now, on the other hand, the higher interest rates offered through these crypto lending companies are offset by some risk. Now, a user must rely on a centralized platform to maintain custody of their funds. And of course, that can be exposed to a single point of failure. Now, if the company actually acts maliciously or falls victim to a hack, a user can experience losses that they can't recover from. Crypto-related financial organizations are not as regulated as banks, and therefore they don't enjoy government insurance policies.
What about decentralized crypto lending platform?
So decentralized crypto lending platforms are essentially protocols that employ DeFi or decentralized finance, smart contracts to automate the lending process. Now, through these smart contracts, lenders can connect with borrowers in a more direct manner that doesn't require the supervision of a third party. Now, recall, we've talked about in previous videos that smart contracts are unchangeable pieces of code that actually are instructions that give instructions that execute as intended or without fail once certain conditions are met. Now, as an example, right, as a lender in the DeFi space, rather than depositing your money at a bank, you would instead select a loan pool as one of these platforms. Now, these pools are essentially like accounts where lenders can actually store or pool their money together and make it available to borrowers. Now, each pool has its own set of rules dictated and enforced by these smart contracts. Now, such rules or requirements include what cryptocurrencies will be allowed in the pool, how long lenders must store their funds, and the percentage of fees that the borrowers will have to pay back. Now, once you've selected a pool that accepts your cryptocurrency that you wish to lend out with interest rates or terms that you're happy with, you can instantly transfer your funds into the pool. Now, unlike banks or centralized platforms, there's absolutely no type of registration, no type of identity verification process required, okay? So in addition, your funds are safely stored in these pools that are not owned by a specific private entity. It's decentralized. So every transaction is transparently recorded and easily viewable on the blockchain, and this is a benefit that you often don't get with the centralized platforms as managing their own internal transactions. Now, say you've selected a pool with Bitcoin and Ethereum, okay? So this means as long as you transfer your Bitcoin to the pool and comply with the requirements dictated by the smart contract, you will automatically earn the predetermined interest rate, okay? So at this point, you may be wondering, why is there a secondary cryptocurrency, Ethereum, associated with this pool? So to understand this, let's now switch back to the perspective of the borrower. If you're somebody trying to borrow funds from a bank, as previously mentioned, you will either need an acceptable credit score or enough assets for collateral. So the concept of collateral is also applied to the decentralized crypto lending space. Now, to borrow Bitcoin from this Bitcoin Ethereum pool, the smart contracts require that you first offer up an amount of Ethereum equal or higher to the amount of Bitcoin that you wish to borrow. This is how the pool ensures that even if you can't ever pay the Bitcoin back, lenders will still be compensated. So if you wish to borrow $100 worth of Bitcoin, most pools will require you to first deposit $150 worth of Ethereum. Now, once you've completed your financial activities, whatever you're doing with the money, the Bitcoin, employing the borrowed Bitcoin, you can then transfer the original amount plus the agreed upon interest back to the pool at any time. And so the smart contract would then immediately release your collateral, Ethereum, back to you, and then your additional interest payment is automatically distributed to all the lenders in proportion to how much Bitcoin each has contributed to the pool.
It sounds cool, but is there any risk involved in lending your crypto on a decentralized platform?
So yes, one of the primary concerns with decentralized crypto lending services is volatility. As we talked about before, significant price swings can easily lead to unstable returns or even impermanent losses for lenders. Now, there can also be bugs in smart contract code, right? So there have been multiple instances of hackers who have actually exploited bugs or flaws in smart contract code and have extracted funds from the pool. And finally, the interest rates are generally determined based on the liquidity of the pools. And so with volatility, vast amounts of crypto can move in and out of these pools with a short period of time. And so with that said, it happens often that interest rates may become increasingly unfavorable, especially considering those opportunity costs.
So what are the main use cases for crypto lending?
For someone who has unused funds seeking profits, right? They're not using their crypto. Crypto lending is an excellent option to earn a passive income through interest payments. So however, because crypto lending requires collateral up front, it may be hard to imagine when or why someone would want to borrow funds in this manner if they already have the alternative assets that can be used, right? But the reality is there are multiple creative and lucrative ways to leverage these types of loans.
Really? Any examples?
Yeah, of course. So the three major ways that I can think of to help people earn more crypto via lending, one would be, interest rate arbitrage, right? A large number of both centralized and decentralized crypto lending options, they offer a wide variety of interest rates for all cryptos. So often a person may find a crypto that can be borrowed at a low interest rate in one pool, but can be lent to earn a higher interest rate in another pool. This, of course, assumes that the crypto used as collateral also has, a lower earning potential than the borrowed fund. The second thing is price speculation. So imagine again that you find a pool with Bitcoin in a stable coin such as Tether, right? And you believe that the price of Bitcoin is going to soon go down overall, okay? So you deposit your collateral of Tether to borrow $100 worth of Bitcoin, but you immediately then sell that Bitcoin that you borrowed, and then the price ends up dropping, say maybe even up to 50%. Now you can purchase back that Bitcoin for $50 and then return the amount of original Bitcoin, and you would have made $50 profit minus the interest fee. And the third would be flash loans. So this is a new and unique innovation when it comes to crypto loan industries that allows users to borrow funds without collateral, okay? So instead of a smart contract, it's actually programmed in such a way that the borrowed funds must be returned back in the original account within one single set of transactions, okay? So this can be a little complicated. For example, you borrow $100 of USDT or Tether through a flash loan with a smart contract that has multiple steps. So such steps may include a number of interest rate arbitrage transactions to yield a profit while still ending up with the original $100 of Tether going back into the lending account. Now, if any of these steps in between cannot be executed in a way that would allow for the money to return, the entire loan never initiates, okay? And so through the multiple steps of the smart contract, the lender can always ensure the safe return of funds plus interest. Now, the main disadvantage of this method is that the coding knowledge required to interact and set up these smart contracts properly is pretty intense. You have to be very knowledgeable when it comes to this option. And so for most crypto borrowers, this is not going to be something that they would do. Now, but for now, the good news is that crypto lending is in its early stages and there's a lot of opportunity. And the current set of available options is already significant advantages over traditional banking. And so as technology and investments into this industry increases, so will the benefits of all the crypto holders.
Yeah, thank you so much, Josh. See you next time.
And thanks for having me.
If our audience still doesn't have a Phemex account, just click on the link in the description, create the Phemex account, and get a 7-day free premium membership trial and other trading bonuses. And for all of you, if you want to learn more about Phemex and cryptocurrencies, watch the videos in the box on the left. And if you are new to crypto world, have a look at the videos on the right side for some Phemex user tutorials. Thanks for watching this video. Bye bye.